Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. The next few videos are going to be slightly different format, a little less official. I have been learning about the options market, and I have been selling puts and calls for the last 4 months. I have had some success and wanted to share it with my friends and on the Canadian Money Talk YouTube channel. I will show you the Zoom call with one of my friends, Karma, who wanted to learn about selling puts. Please be aware that I rank options trading as speculation, but if done correctly, it can lead to some nice income. Please also be aware, as the disclaimer at the start of the video says, that options can be dangerous financially, and that you should always educate yourself and do your own research prior to trading options. As a quick preface, I am describing the selling of put options, which are contracts on the derivatives market. This means I am collecting a premium in cash in exchange for promising, having an obligation, to purchase shares of a certain stock at a specific price, called a strike price. The options expire at a certain date as well. I am generally hoping the stock price stays above the strike price, and I do not have to buy the stock at the strike price. If I am forced to buy the shares at a higher price than they are currently, it is likely to lead to me losing money. If I like the stock, I may be fine with being made to buy the stock, but not if the stock has fallen much under the strike price. I generally want the option I sold to expire worthless after I have collected the premium as income, and if I like the stock, I can buy it normally at its market price. I will do a separate official video on options later. And now on to the third part of the seminar with my friend Karma. If you haven't seen parts 1 and 2, please watch those first. This video will make much more sense.
Hmm.
That means you already have the shares, and now you're selling a call for
Right.
put.
Okay.
You'll notice this is called a cash secured put. So okay, let's go off on a tangent. So this um, you would want to do this in a margin account. And when I say, what I mean by margin is that you have buying power based on your portfolio value, but you don't actually have that much cash.
Mm-hmm.
So Qtrade has said, okay, you have $287,000 worth of stocks in there. We're going to give you, depending on the stock and its value, we're going to give you credit between 30% and 70%
Mm-hmm.
for the stocks that you do own with us.
Mm-hmm.
And they give you credit, and it ends up being about 3-4% interest that they charge you.
Mm-hmm.
But if you don't actually get the shares, they don't charge you any interest.
Mm-hmm.
And so a margin account is beautiful for selling puts, because I don't want to be transferring cash from my checking account in order to in order to sell the put.
Mm-hmm.
The margin account lets me sell the puts, which I do have the obligation, but if the put expires worthless, I don't have to ever transferring any cash.
Right. Right. Okay.
If I do want to keep the shares once I got them, then I can transfer the cash in at that point.
Mm-hmm.
If the put does not expire worthless and it actually gets assigned to me and I do get the shares, I can still sell them even though they're lower than the strike price. I'm now out some amount of money, and
Mm-hmm.
then that money I will transfer in. You can see that happened a couple of times. Uh, so here there was a put on Enercare, which was $3 and it was 20 contract. So I purchased $6,000 worth, and I immediately turned around and sold it.
Mm-hmm.
And so I was out $500. So then you can transfer that $500 in, but up until you actually get the shares. You don't actually have to transferring any cash. So that's why you use a margin account. And so that's why I'm opening a position, but it's not covered by shares,
Mm-hmm.
and it's not covered by cash either at this point. It's covered by my credit,
Mm-hmm.
by my margin,
Right,
right?
right. Right, yeah.
Um, so anyway, this is, if I click submit order, it'll actually go ahead. But this is
Right.
basically saying I want to do 5 contracts or 500 shares. Uh, the limit is 20 cents. I may not get this. Uh, so 500 times 20 cents is $100. There's 6.95 plus 5 times $1.25, so there's $13.20 in commission. So if I were to succeed at selling this on Monday, I would get $86 in cash. Okay. Now I'm gonna cancel this. So if I go in here and I were to be selling a call, then then I would choose open covered if I had the shares.
Mm-hmm.
Call is the opposite, and I don't mean to confuse that. Now the other thing you can do is, if you remember me saying, if I had a bad feeling about BMO and I wanted to get out and the uh, buy back the put that I had sold, then what I would do is I would do buy a put, but this time it would be to close. So that way I would be closing the position which I had previously opened. So
Mm-hmm.
that's sort of another confusing thing. Um, it's not that confusing, but if you're buying, you're opening. If
Mm-hmm.
you're selling, you're opening,
Mm-hmm.
and then to sell something that you bought, you would be selling to close, and then if you're trying to get out of something that you had sold, then you would be buying to close. So
Okay.
there's kind of 4 combinations. Don't let that confuse you. Generally, what I've been doing is I've been selling put and I've been selling open uncovered, and that's it. So all that means is I'm opening a position without having the shares. Um,
Okay. Yep.
but it's quite nice for income, and it ends up with uh, 30% return
Wow.
on the money that I'm kind of putting at risk. And if I were to acquire the shares, as long as the price didn't drop way below
Mm-hmm.
the
Mm-hmm.
strike price,
Mm-hmm.
I would still be positive here. Um, so here's an example. So I had let's go back here. So this is Christie Aviation, I think. This is Air Canada Jazz, and they do all sorts of things for Air Canada. So I sold a put at the strike price is $2.50. I pocketed $1,000 on that one transaction. Okay.
Mm-hmm.
But the price the price went down, so I actually had to buy 30 times 100 times $2.50. I had to buy $7,500 worth of shares, but I got lucky. They turned around and went back up, so I actually sold them for 7,600. So I actually made more money even on selling the shares than I did on the premium. Um, now where's this one? Now was this was a call, I think. Yeah, it was a call. Yeah, so Afria, that one got exercised, and so I ended up uh, I ended up buying it for $6,000, and then I sold it for 58.73. So, but I collected a premium of 780, and so even after selling it at a loss and paying a $70 commission when the shares got assigned to me, I still came out ahead with $583. So that one, if we go back to my chart, that one was kind of in this area here where I was less than premium, but I didn't get negative yet because the price hadn't dropped far enough. Okay. So the the other thing to be aware of with these things is because they are 6 to 8 weeks out before I purchase one of these. I do want to make sure that it would be something that I would want to have if it does get assigned to me and I do have to buy the shares. So I do some analysis of the stock from a kind of classical point of view. So I look at the balance sheet and do all of that. But you also end up using some day trading tools because of the short time frame. So so there's actually a very cool I want to be the other one. So there's a very cool website. Options Plays a training company. There are actually also the one that put out these PDFs. And so, okay. And so they do seminars, but they let you do some kind of day trading analysis, including the strength of the stock. They tell you where the resistance lines are and so on. So because of the short time frame, I do look on here, and they actually have a kind of a cool thing. It's sort of like a wizard. You can go in here and you can click on income, and so I happen to be on Manulife, and so they say, well, I don't know if you can see this. Let me blow it up a little bit. So they kind of give you suggestions. Do you own shares of Manulife? I'm going to say no. So they're going to say, well, then you should try to sell a put for December at $17 strike price, with Manulife being at 18. And they kind of calculate, well, that's going to give you an 11% return. And they also give you other helpful hints, like they know the probability of it going worthless. So this one has 80%, which is quite good. They tell you the annualized return, which I'm able to calculate myself, but they'll also tell you, well, there's an earnings date. So there might be a lot of movement in the stock around the earnings date. And they finally tell you about the bid and ask, which I think we've sort of noticed. So, you know, Manulife, another company that I like, and even if I were to get an extra 11% return, they pay a 5% dividend. If you're able to add 11% to that, you're now getting, well, I mean, with selling puts, you don't own the stock, so you won't get the dividend, but you're getting twice the dividend from the option. So it's something to look at. I also like to use this is Yahoo Finance, and so they have some day trading indicators on here, which I can also look at to see, because you basically, unless you want the stock and just trying to collect a little extra premium, you do want to be right in the direction. So when you're selling puts, you want it to be going up. It's bullish. So at least in the next 2 months, I want to be right and know that it's not going to go below the strike price that I'm selling at if I don't want the stock. So yeah, I mean I do a little bit of analysis, and yeah, that's uh, that's that's what kind of, like, I've only had out of 37, 36 out of 36 options that I've sold in the last 4 months. I've only had four of them where I was wrong on the direction, and on two of them I still made money. Two of them, like this was actually negative. These two were actually negative. But when you add it all up together, it obviously still ends up being positive. So, all right. I hope that was useful for for you to kind of get an idea.
Definitely, definitely. Yeah, yep, yep. And
So,
it's a real world example. Come on, how much better can you get?
sorry, say again.
It's real examples, right? And then
Yeah,
there's a better perspective.
yeah. If uh, if I were you, the least risky options are covered calls.
Mm-hmm.
Uh, but because of the market going up, selling puts is likely to be expiring,
Mm-hmm.
especially if you can do a little analysis and you can pick strong companies.
Mm-hmm.
And then if you do pick a strong company and it happens to nosedive in the 6 to 8 weeks that you're exposed,
Mm-hmm.
and you still like the company, you just keep the shares, and you hope
Yeah.
that you collected enough of a premium to cover the downward trend.
Right. Hold on to it.
Yeah, so selling puts is to me is quite low risk,
Yeah.
because
Yeah.
as long as you have the cash, just in
Mm-hmm.
case it does get assigned to you.
Right.
Otherwise, yeah, you would want to, if you don't have the cash for the whole amount, I would sell what you got and just eat the difference. And
Okay.
yeah,
Yep.
so yeah, 30 something percent return on the money at risk. Not bad. Uh, I've
Very good.
I've slowly been amping things up. I think all it takes is one downturn of the market that lasts for 2 months,
Yep.
and so right now everything in green is expired,
Mm-hmm.
but there's one in November and there's one at the end of October, uh, and so my exposure right now is almost $70,000.
Mm-hmm.
So if there's a downward turn of the market, um, then I would definitely be out quite a bit of money.
Mm-hmm.
Right
Yeah.
now, you can see in here it's looking good, because
Right.
all I have is just the premiums that I collected.
Mm-hmm.
So it's looking great there. It's when it's the date of November 20th, or the one that's October 30th.
Maybe the second wave that could do something. Until then, just cruise along.
Yeah, yeah. So remember, the people who are buying the puts from me are buying insurance for themselves if the stock market does fall down,
Right.
and then they make me buy the shares from them at the strike price. So
Mm-hmm.
the people who bought the shares from me are hoping the market's going to go down.
Mm-hmm. Mm-hmm.
I'm hoping it's going to go up or stay flat.
Right.
So
Right.
yeah, uh, I haven't done anything exciting as far as buying options,
Mm-hmm.
which will be another video.
Okay.
Uh, I will do a video, separate video on all the options and kind of do the basics. But Do you want me to go over anything else, or you think you sort of got it?
Yeah. Today I was only interested in the put cells.
Yeah,
Yeah, and then we've gone through enough examples to
yeah.
understand that.
I've been doing out of the 36, 31 have been puts.
Yeah.
I've been selling puts, and most of them have expired without me having to buy the shares. So I'm happy about it.
Yep.
It's just you for that short period of time you have to be right as far as the direction.
Right.
So it's I wouldn't call it gambling, but it's definitely being a bit of a speculator.
Right. Right. Yeah. Yeah. Totally.
Uh, but if you like the company and you're okay getting the shares, like I have as I mentioned, I like Manulife, so I actually bought. Sorry, I sold four contracts, so 400 at 18, and another 500 at 18. So just from Manulife, my exposure is 16,000. So if Manulife does drop down from whatever it was down to 18, I would just keep it. Like I'm okay with that.
Mm-hmm. Mm-hmm.
So it all depends on whether you like the company or not. But yeah, collecting the premium upfront is nice, but your upside is just limited to that premium. You're not going to get any more, and you could
Right. Right.
actually, if it goes down, you could actually lose the money. But
Downside is bigger. Yeah. Slightly. I mean, if you take action quick enough, yeah, downside can be minimized too.
yeah, if you were to buy back the options, you can get out of it.
Mm.
Then again, the likelihood is that you're buying back the options as the stock price is dropping. So the price of the options that you're buying back is now quite a bit higher than what you sold them for.
Mm-hmm.
Going back to this, so here's the Manulife. Here's the nine contracts or 900 shares. So uh, I averaged at $3.32. So I collected close to $300, but because Manulife maybe has been sliding a little bit, if I wanted to buy those back, I'd have to pay 400 or close to 400. This is what they're worth today.
Mm-hmm.
So I'd be out of pocket $102 net, net, right?
Mm-hmm.
But if I have that bad feeling about Manulife and I think it's going to go down further, then I can get out of it now and I'll just lose $100.
Mm-hmm.
Uh, and in that case, the transaction would be buy put, and I would be closing. I would be closing, and the number of contracts would be the 9, right? And that would get me out of it.
Mm-hmm.
And I would pay $400 for that. And of course, I had earned this earlier, so my net would be negative 102. So that's, but like I said, I'm okay even if Manulife drops down to 17. I'll buy it at 18, and I'll wait for it to go back up again. So um, yeah, all right. I think that's probably enough. Maybe I'll let you percolate on that. Uh,
Okay.
so what you would want to do if you did want to get started is you would want to establish a margin account
Right.
where you don't have to transfer in the cash in order to sell the puts, but you have some sort of a buying power where
Mm-hmm.
you can you can put yourself at risk without actually having to have the cash in there. Uh,
Right.
and
Right.
and I would apply, and you would basically need to be able to sell options. Uh,
Mm-hmm.
So you would fill out the application form appropriately to be able to sell options.
Right, right. Okay.
Okay.
I think I'm gonna get a margin account on Qtrade. I just need to apply for that.
Yeah. Yeah. Uh, yeah. I think a margin account is a good thing, anyways.
Mm-hmm.
As long as you're using it responsibly, and if you're transferring in the cash within 2 days for Qtrade, you don't pay any interest on the anything that you borrowed.
Oh,
After that, you start paying 4% or so. Currently, I think is the goal.
4%?
I think it's about 4%. It's basically an unsecured line of credit.
Okay. Mm-hmm.
But as long as the options don't get assigned to you, as long as you don't have to buy the shares, you can keep selling the options without having to transferring any cash or pay any interest. So
Mm-hmm. Mm-hmm.
kind of handy that way. So all right, well I hope you found that useful. I'll let you go, and if you have any questions, yeah, let me know. I'm gonna stop my share.
Okay.
This concludes part 3 of the Zoom call. Please watch parts 1 and 2 to see the complete summary. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.